Yeah, then I'm excited. So that's an example of when not to be taking the wedge alerts when you see the market not having a clear direction, because you're wanting the market to have a solid direction so you could either trade with that direction or catch a retracement for a reasonable amount of pips. Like if I get a wedge alert in here, I can take the wedge alerts, but they're going to give me, 3 or 5 pips, and you really wouldn't know when to get out because you're like, man, this only went 5 pips and then it's going, you know what I'm saying? So it's really unnecessary trading. So I like to wait for a clear directional move that has happened. When a wedge alert comes in, it's a better opportunity, and you can see the wedge pretty clear. So there will be more examples over time. You just getting familiar with, how the price moves and stuff.
Mm.
But yeah, so even with this one, the next thing I would look for is for the market really to show me when it's going to slow down or go sideways again. And so we have these large candlestick bars, and then we have this small little bullish bar, candlestick bar, and I like this specific type of shape. It kind of looks like a hammer, or I don't even know how to explain it. A microphone. So when it has a small body and then a long tail, sticking out. So I like to see that, especially with the candle that's to the left of it, when this body is less than half of the bigger candle next to it.
Oh, and engulfing.
No. Engulfing is something to where, where's an engulfing? Engulfing is this up here. And engulfing is when the candle completely covers the small candle. So it's initiating a strong movement. This is the opposite of the engulfing. This is when this is I'll pretty much tell you what's going on. So the market right here is slowing down and then coming back in with a lot of volatility really fast.
Mm.
So the market here is coming down with a lot of volatility really fast and then slowing down. So
Okay.
that's kind of the difference. So the market's slowing down and then trying to turn around, and then the market comes in with a lot of volatility. There's going to be strong candles, bars engulfing all that moves. When there's already strong volatility really fast, the market's going to turn around in the opposite type of way. So it's going to go from, so in this example, the market's slow, so it's going to go from small candle bars to large candle bars, and then go in the direction that way. Here, the market is going to be coming from large candle bars and a lot of volatility, and it's going to have to slow down with creating smaller candle bars. So I like the candle bars that are something like this, usually 50% to 25% of the previous candle. If we even get a doji, which is kind of like the I don't know if an example here, but right here. Do you see this?
Mm.
If I can zoom in.
Oh, it looks like a cross.
Yeah. So when the market goes up and down and then it opens and closes pretty much at the same price.
Oh, yeah.
And it looks something like that. Those, though, I like to see those too. So when I see that, is that's my signal to really to get out of the market, because I know the market's slowing down. And that's what it ended up doing. So, right here, that's that's 31 pips. And then boom, you know what I'm saying? That's definitely a successful trade. Another thing I like doing is actually using this type of reversal pattern with the candlesticks to actually get in the market. So here, there wasn't really anything that I could use. This was just a good wedge alert. But let me see. Let's see. So there's maybe a wedge here. just because I know that this did break.
Oh, yeah.
Oh, um, yeah, again, the wedges don't gotta be perfect.
Okay.
They just gotta be, you know what I'm saying? Like this is so I really like to get them to touch and go like that, you know, but you don't got to.
Okay.
But so we have a wedge here, and with this one, we actually have a breakdown here, and we don't have the candle actually coming any price coming back up to touch there, right? So this would have been a clean breakdown, and then what? This would have been an 8 pip stop, you know, and then the market it was pretty much good, but we do have this retracement. So if we would have been able to just come in here, cool, 10 pips, set our take profit, we would have just taken that. You know, I wouldn't have been able to have a second trade. I would have taken that, but once the market comes over here, we may have an opportunity to take a second trade on the retracement of this breakout. So
Okay.
so but I wouldn't just do it. I wouldn't just say, oh, it's always going to come back up, because if I'm thinking like that, then I'm waiting for it to come up here for it to necessarily touch, you know what I'm saying, this trend line here, you know, and the market doesn't go there. So when you're paying attention to the actual candlesticks, you can also look at that as well. So I see a large volume here, right? This is an engulfing. And then I see the markets come and turn around again by creating this type of, this small candle bar that I like to see next to a large volume. And then I like seeing that little, you know what I'm saying? This is like a 10% of this candle here. It's really small. And
I don't see that because all I see is a long, between it. Wow, I can hardly see that. Okay.
Yeah. So yeah, that's how small it is right there.
I see it now. Okay.
Yeah. So when I'm seeing a candle bar like that, that's letting me know, since I already know the market is breaking down, it's bearish, I'm not paying, even though this is a strong bullish movement, I'm not looking at this like, oh, the market's turning, it's a strong bullish movement. No, because I know the direction, so I'm just looking for the selling opportunities. And this candlestick bar, even though it didn't come up to retest here, the trend line, it still is making a retracement confirmation. And I would actually take this trade at the open of this candle,
I see.
and let that one run. And something that's cool is like, this is where Fibonacci's come in. I don't really need to use Fibonacci's a lot. They're just cool sometimes. And sometimes the market's not clear, I'll use it. But if I draw Fibonacci, I'm actually going to make this a little bit different because I don't use all of these lines. So the market comes right up into the level that I like to see. It touches it with, about a pip, so it forming this after it touches that level would be a confirmation of that retracement to this down move. And I like drawing my Fibonacci's. I put in my own levels based off of what I've seen the market do. These levels down here are the extensions of the measurement of this retracement. So pretty much, if you're going to measure a Fibonacci, you're going to draw it from top to bottom when it's a down a downtrend. You're going to measure the first wave, or the wave that you're looking to measure the retracement, and the numbers is the percentage of that wave. So if you had a 50 level, that would be a 50% of that wave there. You would be measuring. So you would be looking at the market to come and make a 50% retracement of the current direction. But here I like to put in 70%. I've seen the market exhaust at that point the best. So I have mine at 70% retracement, and then here is where you have the extensions. So if I'm trading a 70% retracement, I'm going to input a negative 70%. So an extension. So this would kind of be where I have an idea where to take my profits at. So if I'm taking a 50% retracement, I'm going to get out at the contrary 50%. What's it called?
Okay.
Extension. So a lot of people don't realize, you can customize your Fibonacci. So I like using it to measure where I can possibly get out at too, and things like that. If whatever. So that's how I use Fibonacci. I use it in conjunction just with the price action if it's not so clear to me. But whatever. So there's that wedge. This wedge is a little bit different, but it's still the same. It's still presented two opportunities to trade. And this one, if I had let this run, this gave us about 40 pips. Which is pretty solid. So in total, this is on one pair. This is USJPY. And this so we got two wedge alerts from the same pair in one day. So this came in around 8 a.m. Eastern, this wedge alert, and then we got a wedge alert coming in at 4 p.m. Eastern. You know what I'm saying? One in the morning, one in the afternoon. Cool. You know what I'm saying? So that's kind of, these are pretty easy wedge alerts, or just visually being able to see. That's an example. These are an example of trading in the direction of the trend. So these wedge alerts are measuring the retracement of this trend. You'll get wedge alerts that will be counter trend.
Okay.
So in essence, how can I explain? You'll get wedge alerts that will be counter trend, meaning instead of there'll be a downtrend. So the same downtrend, if it's price action, I find it a different example. But instead of getting an ascending wedge alert in a downtrend, you'll get a descending wedge alert in a downtrend.
Okay.
So sometimes you'll get that, and those, it depends on the volatility. I don't like trading counter trend unless there's a lot of volatility, because the market may come back really fast on you, or it just might not be a good opportunity because it's a counter trend. But sometimes I like the counter trend if there's a lot of volatility, because you can really catch some, momentum. So I'm trying to find an example here. So we need a so looking for ascending wedge. No, we're looking for a descending wedge. Let me see. So let's turn this one around here. This is not really too. I mean, this is a very small little wedge, but sometimes you'll get an alert saying there's a descending wedge,
Okay.
and you go into the market and you're like, what the heck is it talking about? Because it's barely a wedge, barely an opportunity, and I can see them when it's giving me alerts, but I'm seeing like just like, yo, it's giving you something that's technically there, but it's not an opportunity because it does break and it does have a descending wedge, but you have a break here and then that's it because it's in a trend. You're only able to capture that and then what I'm saying, boom, it's back. So I mean, if you were able to catch this, I mean that's what, 7 pips, okay. But that's really fast, and a lot of people may not know how to get in and get out of that type of scenario.
No, I wouldn't. Mm-hmm.
Yeah. So even here, if we got a descending wedge here, I know the market's been sideways, but I know the market has been setting up to make a bearish move because of this previous day. I'm looking for the market to make a retracement from all of the bullish. I'm looking for the second wave, second retracement. So I know I'm anticipating the market to come bearish, but it gives me an alert saying descending, looking for a bullish break. So then I would be looking for it to break to the upside. And I'm not going to think this is going to be all some huge thing just because I know what the market's doing. So here we have a small little descending wedge. You know what I'm saying? And we have this market with the price action, small candle bars. So I'm not really looking too happy, but it technically it works. So we have a break here. Even if I make this a little bit steeper, so then technically this one's whatever. Either candle. We have a break and close here, and then here, and then the market comes up 6 pips and then drops really fast. You know what I'm saying? So technically, I'm saying that this is a valid descending wedge breakout, but it's not giving you much of an opportunity because you're going against the market. You know what I'm saying? The probability is very low, I guess I would say. So the difference is there's low probability setups and there's high probability setups. These wedges are a higher probability, not just because the direction, but because of the volatility. Here, we know the market has been going sideways, so that means low volatility, and then it's giving you a signal that's giving you telling you there's an opportunity to trade against the market, bias. So usually, if I am going to take these trades, my take profit is 4 pips. You know what I'm saying? I don't want to get really more than 3, 4, or 5 pips because I know it's really not going to go more than 3, 4, or 5 pips. And another thing is there's specific pairs that are more volatile than others. When it comes to the Aussie USD or the USD Chief Franc, those are lower volatility. So those pairs are not going to give you 10 pips, 30 pips on one wedge alert. So I'm really more conservative. The pairs I like to trade are the British Pound USD, this pair, which is the USD JPY, the Euro USD, and anything else besides those, I'm only trading it if it's good enough of a opportunity, just because they're low volatility. And if I don't see any other trades, you know what I'm saying, I'll maybe take those. But you don't have to trade every day is the thing. If you would have profited off of these 2 wedges, but you're good for the week, you know what I'm saying, you just made like 100 pips right there. So I'm going to show you what I like to do. So here's the compass.
I'll ask you a quick question. For the 3 volatilities, you said GU, EU, and UJ.
Yeah, I'm opening it up to the Compass software. And so the pairs that it does give me alerts on is it gives us Euro USD, it gives us Aussie USD, New Zealand USD, USD JPY, British Pound USD, and I think also USD Chief Franc and gold. So from highest volatility to lowest, it's going to be gold, then it's going to be the British Pound, and then it's going to be the Euro USD,
Okay.
and then it's going to be the USD JPY, and then it's going to be the USD Canadian,
Okay.
the USD Chief, and the USD the Aussie USD. So that's from like the highest volatility to the lowest volatility pairs, and things like that. So I do like to pay attention to that, as well as when the time of day is. I specifically like trading in the mornings during the New York session because of the volatility and the activity of the U.S. dollar. That's New York, banks, the American banks. So I like trading the USD pairs during the U.S. market. Trading them during the at night during the London market is cool if you're trading, the European pairs and British pound pairs and various things. Obviously the Japanese, I like trading the Japanese during the Asian market, which is, at the market open. So there's specific details as well with paying attention to these alerts. I like to trade them in accordance with what is going to create the best opportunity. If I get a US JPY alert in the middle of a New York session, I may not pay attention to it as much, just because I'd rather wait for an alert that's going to, unless it's really good, so I'll trade the pairs in accordance with what actual bank session is going on at that time, which is also an indicator.
Thank you. I took a lot of notes.
Yeah, everyone's missing out, man.
Yep. I guess was this recorded or no? It doesn't matter because I took notes. I'm just curious.
Yeah, I didn't record this one until the last half, but it's fine.
Probably not. I don't think it recorded that. Okay.
Yeah. So yeah,
I haven't been using Trade Compass that much, but I'll have to get back.
Yeah. So also what I do in the group is when I get an alert that I actually am paying attention to, I usually let the group know, hey, this alert came in. I think it's good. Let's see how it does.
Okay.
And then I'll keep posted. I'll post screenshots and stuff. I'll let if I actually end up taking the trade or not. So I really kind of just walk people through, like, if I see an opportunity, I'll show you what that looks like. So that's also cool for people who are learning and stuff and various things.
Okay, great.
Yeah.
How many alerts do you think you act on, let's say, in a week, on at like the lowest range?
Minimum. I'm probably taking like 10.
Okay.
Because I'll try to look for 2 a day, but then if not, like sometimes, honestly, I would say the minimum could be like 3 to 5 alerts in a week. If there's a lot of opportunity, I'll take more. Like last week, I only took like 3 in the whole week.
Okay.
But they were really good ones.
Well, thank you. This is so helpful. I'm gonna have to practice too.
Yeah. I mean, you mean you don't got to do it all the way on live market. You can do it on the historical data, and then live market you can practice to see if you get it right. Also, on a demo, see if you end up doing it, setting it up right, and see how it plays out.
Oh yeah, historical data. That's a good idea.
Yeah. But all right, I gotta get going.
Okay, thank you so much for your time. I really appreciate it.
Yeah, definitely. See
Okay.
you.
All right. Have a good night. Bye-bye.